As someone considering buying or selling a home, you are likely paying close attention to the mortgage rate and wondering what's ahead. Here's a really quick breakdown of how the federal funds rate impact mortgage rates and what you can expect moving forward. My name is Danholm, and I'm a real estate broker and a marketing expert here in Central Florida. I've helped countless people move from one home to another in the area and beyond, actually. Today, I'll talk about what I believe you need to know about mortgage rates and the federal funds rate if you're buying a home or even selling a home. I'm not a mortgage or financial advisor, so this video is not intended as mortgage or financial advice. It is purely for informational purposes. So now that we have that out of the way, let's get started. The federal funds rate is the interest rate at which banks lend money to each other overnight, which basically is another way of saying from day to day. While the Federal Reserve, also called the Fed, doesn't directly control mortgage rates, it does influence them through this rate. When the Fed lowers the federal funds rate, it puts downward pressure on mortgage rates and all other interest rates, making borrowing cheaper for consumers. If they raise it, it goes the other way. There are certain key metrics or important statistics, if you like, that the Fed use as a guide for their decision on which direction they want to take the federal funds rate. One of the most important ones is the inflation rate. Currently, the inflation is considered to be high, meaning that prices are going up way quicker than the Fed would like. The Fed's goal is to lower inflation to 2%, and while it is moving downward, it's still above 2%. In June of this year, 2024, it was 2.6%. So we are definitely going in the right direction. The inflation has been going down steadily over the last few months, but it's not quite where they want it to be. Job creation is another key indicator they're considering. The economy is adding new jobs, but at a slower rate, which is actually what the Feds want. Why do they want that? Because if jobs are added too quickly, it is seen as a sign that the economy might be overheating. So they want a slow but steady increase in new job creation. The unemployment rate is also important. At this rate, the unemployment rate, this time the unemployment rate is low, but it's been gradually rising. And as productive as this might seem, a higher unemployment rate is actually seen as a good thing because it reduces spending and helps keeping inflation under control. So what does all this mean moving forward? Well, most likely mortgage rates will continue to fluctuate in the coming days and months. Although the economy is showing signs of moving in the right direction, the direction at least the Feds want, it is unlikely that they will cut the federal funds rate anytime soon. The Fed Chair Jerome Powell recently emphasized the need for more consistent data before loosening the policy. So that's an indicator that he's not quite ready to lower the interest rates right now. According to the CMA FedWatch tool, there's a 96.1% chance that the Fed will lower the federal funds rate in September, but only if the current trends continue. So while the Feds do not set your mortgage rates directly, as we talked about before, their actions on the federal funds rate, they heavily influence mortgage rates. So what's the bottom line to all this? Well, economic data suggests that mortgage rates may improve soon. However, trying to time the market can be really risky. It's essential to rely on a trusted local real estate agent to stay updated on the latest trends and understand what they mean for your home buying and your home selling decisions. So you should count on your local real estate expert to guide you through these changes and help you make informed decisions about your real estate investments. So if you want a brief consultation, absolutely totally free and without any obligation whatsoever on your part, just give me a call. I'm here to answer all the questions you might have. And remember the old saying, which I've slightly paraphrased: the best time to buy a home was 30 years ago. The second best time is now. So if you need to move, don't let the market hold you back. It is never a bad time to invest in real estate. My name is Danholm. Thanks for watching. Until next time.